Good morning or afternoon, I suppose, to everybody who's tuning in. Thanks for joining us on this uranium webinar. I'm really excited to go through this event today. We have two fantastic uranium brains here to share some insight on what's been going on in the space, why it's happening, what it means, where we're going, and of course to share the companies that they are each leading and why we all collectively think that they are good horses to ride for this bull market, if you agree at the end of this that is where we're headed. So yes, thank you so much for joining. What we're going to do is start with the space. So I'm going to lead these guys through a discussion of what's going on in uranium by asking them questions and forcing them to give me answers. And then each will take us through their company and a little brief run through of uranium royalty and ISO energy. And then at the end, we certainly want to invite questions from all of you. Now, don't wait till the end to give us those questions. Your control panel there gives you the opportunity to ask questions at any time. So you enter questions on that control panel and they show up, I can see them. And so I will, make a list of those questions as we go, and I can forward them on to these guys in the Q&A at the end. So please ask questions. But to start, I am going to be the one asking the questions. So I'm going to start. Clearly, the big thing in the uranium space has been the change in production, and that there's sort of two legs to that. We had a whole bunch of production cuts over the last 3 years, and then we had production cuts over the last 3 months based on COVID. So Craig, why don't we start with you? Can you put those production cuts in context? How much has been cut? How does expected output in 2020 now stack up against demand after all of this supply has been cut? Let's go through that picture.
Sure. Thanks, Gwen. Thanks for having us on. So, and I'm happy to answer that question. Scott's probably better placed because, we're an esteemed company here. Scott's a true legend of our sector. So, it's a great panel to be on. So thanks for that. So, look, over the last 3 years, we've seen massive supply cuts, of course. We were fairly dramatically oversupplied back in 2017. If we were producing today at that sort of annualized run rate back in 2017, we'd be producing probably 175 million pounds per annum today. But we've seen significant closures, of course. We've seen Kazatomprom shut one of their mines. We've seen probably the biggest news in the past 3 years in terms of production cuts was the closure of Cameco's McArthur River mine. Of course, that was the biggest point source of uranium in the world up until its closure. And that reduced the global annualized run rate down to about 140 million pounds. And of course, demand sits at about 190 million pounds. So we're being a significant undersupply with all of those closures. And then of course, COVID-19 comes along and we've seen further dramatic closures. So we've seen Kazatomprom close its production. We've seen Cigar Lake from Cameco close, Namibian production. So by our estimates, we think the sort of annualized production run rate right now is somewhere between 100 and 120 million pounds. So we're really sort of in a situation where we're 50% undersupplied today. And so, and as I always say, this is a supply side story. And then in the meantime, we haven't seen any appreciable drop in demand, maybe 5%, but of course, global demand for electricity and nuclear powered electricity hasn't dropped off at all. So this leaves us in a massive undersupply scenario.
And just the first half of that answer was about the group of uranium producers in the world collectively deciding to cut back on production to turn the space around. And they did that because there had been so much excess in the spot market. Why had there been so much excess in the spot market? What put uranium in that position to begin with?
Sure. So, look, of course, we saw back in 2011 the flooding of the Fukushima nuclear power plant in Japan, and that saw, excess product in the market. And that often gets a bad rap, but really, our perspective is that the driver for product in that spot market, that oversupply scenario situation, if you like, is in part driven by, you know, Scott and the team. Scott's an advisor, of course, to Kazatomprom. And really we saw from 2005 through to 2012, Kazatomprom went from negligible production, a few million pounds a year, to being the biggest producer in the world, 40% of the market provided by Kazakh producers and largely Kazatomprom. So, you know, cheaply produced uranium out of Kazakhstan's driven that to some extent, but certainly I think, you know, Scott can expand on that and explain a bit more there.
Yes, that's definitely where I was going to go next. So Kazatomprom's shifting approach to where it sells uranium has been an important force over these 3 years, and I think it continues to evolve in important ways today that are flying a little bit under the radar. So can you just take us through? You are uniquely informed on this, as Craig says. Take us through how those sales strategies have shifted over the years from sort of grabbing market share to that not being the driver.
Yeah, well, and Craig, thank you for those kind words. It's great to be on with you and Gwen today. It is appropriate to focus on Kazatomprom and what they're doing. For much, you know, of my career, you know, Cameco used to be the world's largest producer and was the swing producer, and everything they did or didn't do obviously had big impact. Of course, in recent years, Kazatomprom and Kazakhstan has eclipsed Canada and Cameco as the largest producer in the world. You know, that's not an easy shift for a company that, you know, was a state-owned company and very much driven by things other than profit or free market principles. But there has been a realization, and I honestly think that the uranium price is falling down into the low 20s about 4 or 5 years ago, really began to send alarm bells off with the Kazakhs that even with their low-cost production and 21 various mines and JV, their profits were beginning to be squeezed, and out of those profits, a lot of the social welfare and support of rural communities around those mines are impacted. So it was really out of economic necessity that they took a different approach on production and marketing, but also their desire to go public and become a market-driven company instead of a state-owned company. So it was as part of these initiatives that I went over and served as an advisor to the CEO to really put together their marketing strategy, which really can be summarized in 5 principles, all of which are positive for the market. Now we're watching Kazatomprom very closely to see how well they're living up to these 5 principles. But again, all 5 of these are really meant to improve market conditions, reduce oversupply, and they can easily be described by 1, production discipline. They were obviously producing far much more uranium than the market needed. It really wasn't only until 2016 that global uranium production peaked and started to come back down. That was never going to be a good situation. We had falling prices year over year and production going up year over year. A lot of that was attributed to Kazatomprom. So they took production cuts, first 10% across the board and then 20% across the board. And then the COVID cuts, which are much more recent. So that's an important step to not be overproducing into a market. Every pound that Kazatomprom produces that doesn't go in the long-term contract would end up in a spot market. So one of the key advice that was given to them was keep your pounds out of the spot market, delivering the long-term contracts. Second was if you still have long-term or you still have production beyond your long-term sales commitments, pursue quarantine sales. What I mean by that is there are entities like UPC, Uranium Participation Corp, or Yellowcake that can buy that excess production, quarantine it on behalf of investors, and allow them to speculate on a pure commodity through an ETF type investment. So that's something that they pursued quite dramatically with Yellowcake out of London to take a lot of their uncommitted production off the market. Third, avoid offtake agreements. This was an important step because Kazatomprom was not as savvy and experienced in global marketing and sales of uranium. They relied heavily on traders that would take their production and then effectively dump it in the market. They're buying at a discount off market and putting it into the market. So while it was an easy button for Kazatomprom to place all their production, that production would be better than marketing into directly into utility contracts rather than through traders. So they've largely cut off a lot of that trader activity in long-term offtake agreements. That leads to the next principle, which is really to adopt best practices in uranium marketing and sales. Follow the lead of companies like Cameco, like Urenco, these companies that are very successful and have achieved very large market share without damaging the uranium market in the process. And then the fifth was establishing a Swiss trading subsidiary, which allows them to be more flexible in their marketing and not pursue just rigid sort of transfer pricing type strategies that are dictated by Kazakh transfer pricing laws, but adopt more responsible global sales and marketing tactics. So these all, are positive. We obviously watch Kazatomprom very closely to see how disciplined they are being. But listen, the intent is there on their part to be that global leader. I think it's out of their own self-interest as well to see a healthier uranium market, and they've taken a number of steps to kind of get there. So it's definitely been a positive transition, even though they probably still are today producing. If we had our druthers, they're probably producing more than we would like, but it's certainly less than they had planned to produce.
I can only imagine what an interesting few years that was for you, helping to change those mentalities and enact those principles. I mean, that's an 180-degree shift in mentality. So it must have been a really interesting process.
Yeah. No,
so,
Gwen, you're right. The old Soviet plan was you produce more of anything. If it's widgets or anything else, more is better. No one comes into a Soviet planned economy and says, let's produce less next year. That person gets sent to Siberia. So it was a complete change in attitude that they've adopted. But they've really made big strides.
Okay, so making big strides is important broadly, but it's almost specifically important right now because there is sort of ironically, COVID has brought about more reliance on the spot market from some of the big players in uranium. I mean, the easiest example is Cameco. They shut down Cigar Lake. Now they need to buy pounds in the spot market to feed the contracts that they're obliged to because they're not producing those pounds. If Kazakhstan, has been reducing the amount that it's selling into the spot market, now is producing less, continues to actively try to sell less and less into the spot market, where does that leave the spot market? How big was it? How big is it now? Is it big enough to supply the pounds that Cameco needs? Because that certainly seems to be the classic supply-demand thing that would tip the spot price in way higher.
Yeah, exactly. I think one way to look at the spot market is like a bathtub. And in the years following Fukushima, where uranium production was increasing year over year all the way through to 2016, even though uranium prices were falling year over year, we were basically having a bathtub that was overflowing and the faucet was turned on too high and the water was overflowing the tub and going onto the floor. So it really took production constraints to dial that faucet back so that the amount of material coming into the spot market reduces. So then we can start drawing off, whether it's Cameco buying in the spot market or utilities beginning to purchase more material in the spot and medium-term market. So really 2017 onward, which is not that long ago, really is where we've really seen the rebalancing occur. The spot market itself traditionally trades about 40 to 50 million pounds a year on average. But we've seen in the last couple of years that's really jumped up dramatically. In 2018, that went up to 90 million pounds. In that year, we saw about 65 million pounds last year. And already in this year, we're up to 50 million pounds and we're only in June. So this could be, if it continues at this pace, could be a record year for the spot market. Now we have to understand that that's not 50 million pounds or 90 or 100 million pounds of reactor demand. That's the volume of material in the spot market. The utilities going into a year globally may only need 5, 10, 15 million pounds to purchase in that year. Often it's much less because the utilities don't leave their reactor needs to the last minute. They'll leave some discretionary purchases. If you measure the United States last year, utilities in the US purchased about 8 million pounds in the spot market. So that gives you an idea of how much volume is traded beyond the utilities. It's traders, it's producers, it's funds like UPC and Yellowcake buying materials. So while they can't be, they're not as important demand as reactor demand, they provide an important role in the form of liquidity that keeps the market flowing with supply and demand that creates a functioning spot market. Even as it is, and we'll talk about it, I think, a little bit more, is uranium is very much an inefficient market. It's not as efficient as copper, gold, or established commodities. So the more liquidity we have in the spot market is a good thing, even though sometimes when the market's oversupplied, that liquidity and trader activity, kind of facilitates lower prices. But we're now beginning to see what's more important is the utility demand, reactor demand, being filled in the market. And as the utilities came into the market in 2020, before COVID-19, we really saw finally this resumption of utility contracting in the spot, medium, and long-term contracting that's needed to kind of be the last catalyst here. Supply's been cut back. Demand, reactor demand, is strong at pre-Fukushima levels. We needed the utility procurement. And it's not that they hadn't been active in recent years, but they had been less long-term focused and more myopic on the short term. And remember too, just because utilities might only buy 5, 10, 15 million pounds spot market, that doesn't mean that they're not drawing more material off. Think about traders that engage in carry trades, where they will buy spot material off the market today, carry it on their balance sheet at a low cost of money, and deliver to a utility over the next 2 or 3 years. That's become the real preferred route for utilities to contract in recent years, which is not good news for producers because it takes the power away from producers to sell under hedged long-term contract prices, because basically those carry trades are low spot priced uranium, available spot priced uranium, low cost of money, and just perpetuates the current weakness in the spot market. But as interest rates or availability and cost of capital goes up and spot supplies go down, the power is shifting now back to producers to be able to dictate what prices are in a contract that might start 2 years from now and continue 5 to 10 years into the future. Producers have not had that power for 5, 6, 7 years. It's incredible to think about that. But that's an important stage here for mines to get off the ground, developments to move forward, where they, they're not relying on low spot prices under $30, which doesn't incentivize anything, but they can get back into the $40, $50, $60 contracts under long-term arrangements that they need to stimulate production.
So I guess, the shift to putting that power back in the hands of producers is certainly key. I've spoken with you for years about wanting those long-term contract numbers to rise as the thing I was watching for, as an indication that uranium was back again. How do you have an idea how tight the spot market might be this year, based on producers needing to, based on all the factors that you just mentioned, less supply coming in, producers needing to secure more, carry trades playing whatever role they play? Do you think that the spot market is actually tight now?
Yeah, it's funny because we talk a lot about oversupply, and the market, has an overhang of material, and it kind of gives you this impression that there's this just, big, glacier of material that just can move on to the market and swamp any amount of demand. That's really not the case. And if you talk to anyone who's in the market, I saw when I was managing the UPC uranium activities, when I'd go into the market to buy quantities, you might get a small quantity offered at the published spot price today. But if you needed to clear off 1 million, 2 million pounds, 3 million pounds, you're finding that the supply side, that deck is pretty thin, and you're gonna see significant price appreciation. I think Cameco's seeing that when they're in the market and they're buying. I think they time their purchases when will have the biggest impact. So sometimes they'll pull back if they think it's not the right time, but other times if they see that the supplies are very thin, they'll go and clear off material. We're also seeing that the carry trades are becoming less prevalent, which also would mean that spot material is getting harder for them. If they do a sale of 1 million or 2 million pounds forward with a utility, but they can't source the 1 million or 2 million pounds today in the spot market, that means that it's getting tighter. So these conditions were all really coming together, and it's one thing that COVID did kind of cause the utilities to step back on their contracting, feeling that, okay, maybe now during a crisis is not the right time to be active in the market. So, that was kind of an unintended consequence, but the utility demand is not going away. Frankly, they should have already been contracting very heavily, up to this point. But I think, we had other stuff last year and the last 2 years. We had the trade issues out of the United States, which caused utilities to step back and see how that was resolved before they made big contracting decisions. So we've had a series of things that have put the utilities off, which in terms of the uranium investment narrative is not a bad thing. The closer they get to actual demand and uncovered needs, which are quite significant in the coming years, the better it is for price formation, because they really don't have the luxury of waiting anymore. They have to buy.
Yeah. Okay, let's take a step back from the details of contracts and spot market and supply. If we assume that the fundamentals are pretty bullish, which I think the three of us would agree upon, let's put that into the current context of this crazy COVID scenario. So as maybe a parallel, copper is being hindered. It has strong fundamentals, but investors buy copper as a bet on global growth. If that isn't the dominant theme right now, then they're not buying copper. So for years, from your years in the sector and your conversations with investors over the last few months, Craig, what's your sense of how ready investors are to bet on uranium based on this fundamental strength amidst all of this COVID economic uncertainty?
Yeah, sure, Gwen. And sorry, I'm having a few technical difficulties, so I only got the last part of that question. But I think, the answer there, look, of course, we're the best performing commodity this year so far, up about 45%. We've taken a little bit of a break now in that rise in spot price. Of course, we've jumped from $23.50 to $34 a pound. It's sort of flattened out. And I think, Scott might correct me if I'm wrong, but it's really been the announcement of those closures and cutbacks in production and some of the other commentary that's going on that's driven that spot price up. And I think, just on the topic of Kazatomprom, your CEO there, Scott's been very vocal about not wanting to feed product into the spot market this year. Carry trade, the guys in the carry trade are going to lose their business now that product's drying up. So, to us, it's quite clear that the prices will start to rise further. And I note that Permatov said the other day, back on the 22nd of May, that of course those production cuts from Kazatomprom, there's a lag time before you stop drilling those wells, the head grade starts to drop, and you've got 3 months of lag before that product disappears. So, a long way of answering your question there, Gwen. Where do investors stand on all of this? I think there's so much new information that people need to get on top of. A lot of things that people understand. You can see Scott's been in the industry for 30 years and has a deep understanding. He'll be getting lots of questions like I am from investors at the moment. I'm involved in a private equity fund that I helped start called EMR Capital. One of the guys there started showing interest in the sector again. We're starting to see, we've gone from a stagnant pool of investors to a trickle over the past couple of years. Companies like ISO Energy, we've managed to raise $20 million for exploration at a pretty difficult time for the market. So that trickle's been there. But I've got to say, we've never been busier, and in the past 3 months, the interest in the sector has returned massively. We've been, you can see, so of course we're in essence a subsidiary of NextGen Energy. Lee announced his placement to QRC Capital, Queensroad Capital, a couple of weeks ago for 30 million. So that's a big chunk of money coming to the sector. Again, I've never had as many bought deals thrown at me. So, something's happening. But it's mostly guys that are invested in the sector, know the sector well, the thought leaders in the investment side of the space, guys like Sachem Cove, Mike Alkin there, Segler Partners, those sorts of guys, they've got their bets on already. but very pleasing to see that we've had a serious amount of interest from a number of generalist funds. So things are really picking up. It feels like we're on the verge of something, and I think going back to that point about Kazatomprom, given the production at those wells in Kazakhstan dries up over the next month to 2 months, you know, with that product actually removed physically from the market, we could see much higher prices, and then that's when that wall of money will come in and hit us. So, you know, it's a critical time for our sector. It's going to be a very exciting few months ahead.
Yeah, I mean, I agree. Whether it happens, you know, whether it kicks off right tomorrow or you know, weeks, months time frame, it certainly feels very much like we're heading in that direction. Scott, this is sort of a bit of a broader question, but uranium bull markets are incredibly intense affairs. I mean, a lot of investors on this call are probably gold bulls as well, but uranium bull markets put gold bull markets to shame. They're almost an order of magnitude more intense, the gains and yeah, the scale of it. Why does that happen? Why are uranium bull markets so dramatic?
Yeah, you know, it's a good question. It's something that, you know, I've observed over the last 35 years. But I think there's a real fundamental answer to that is the inefficient nature of the uranium market causes these extreme movements in uranium price, far beyond what a normal economist would say should be a market clearing price. I mean, I hate to generalize, but maybe, you know, uranium should trade at $45 to $65 a pound in a perfect world. But instead it goes to $10 to $20 a pound for long periods of time, and then it goes to $137 a pound at other times. That's because we're not like copper or gold or zinc or silver, where price signals really translate into immediate supply additions and supply cuts. And those other commodities, there's mines that can come on quite quickly or come off quite quickly. With uranium, because we have such a high degree of hedged contracting, take, for example, the years between Fukushima and the peaking of production in 2016. We saw production increasing year over year, even though spot prices were falling. That doesn't seem logical unless you realize that most producers were delivering into contracts signed, legacy contracts at higher prices in the past. It was only until those contracts rolled off and expired that they became exposed to the low spot prices. Well, that creates a multi-year lag, and it creates these oversupply situations. So this inefficiency in an oversupplied market really kicks the uranium market in the teeth and causes prices to go far lower than they should, and stay down longer than they should. Now, the good news for uranium investors is that inefficiency works in your favor when you go to an undersupplied market, because it takes a long time to permit, license, and build a uranium mine, and build anything in this day and age, but a uranium mine especially, you're talking 6, 7, 8, 10 years could be, if you use McArthur River as an example. You know, that creates a situation where uranium prices could be increasing quite dramatically. Now, you're going to have some incremental stuff that can come on, stuff that's permitted, licensed, like maybe some ISR production in the United States, still not big volumes on a global scale. You can have restarts of mines like Cameco and Kazatomprom. But even after you take into those restarts and quick starts into account, we still have a very significant deficit developing within the next 5 years. So we're well within the time period that's needed to meet the required amount of uranium in the 5-year horizon. But we've got a 10-year lead time to get mines into production. So that's what gets interesting in our business, because you can have, you know, uranium prices don't necessarily trade at the theoretical equilibrium price. They go to wherever the market will bear. Uranium demand is inelastic. Uranium, you know, nuclear plants can't run on coal. They have to run on uranium, so the utilities are forced to pay whatever the market will bear. And that's where we've seen these wild swings. So I think it is reasonable now for investors to look at the uranium market and say, all right, what are the similarities of the last bull market? We had underinvestment in mines for many years. We had cutbacks. You know, there weren't new mines being developed. There wasn't incentive pricing there. Back then, the demand story was future growth. It was looking forward to the growth of China and India and everything, but it was still very much future looking. Well, now we're in the growth. We've had 47 reactors come online in the last 6 years. We have 54 more being built as we speak. So we're in the demand, like the reactors are being connected to the grid and consuming uranium. So the demand story couldn't be more robust. We're at pre-Fukushima levels for nuclear generation globally. Production is falling, as Craig said, to 120 million pounds or lower this year compared to demand at about 190. That's quite a significant deficit. Whatever that overhang in inventories is going to be drawn down quite dramatically and in an accelerated fashion. So that's where we're seeing it today. And I think it's important. A lot of investors might look at it and say, oh, this is all COVID-19 driven. No, COVID-19 was the tipping point. The story has been the fundamentals over the last 4 or 5 years, with production cutting back, demand returning to pre-Fukushima levels. It was only the COVID cutbacks that occurred that really pushed it over the tipping point and accelerated this drawdown beyond what was already happening. So it's important to note, because that would, COVID is going to go away and mines are going to restart. But I don't think that's the end of this uranium bull market. It's been the tipping point to really move things forward.
Yeah, that was a great summary of why this happens. Fantastic. Okay, Craig, I'm going to do one more question and I'll take it back to you. Just like with gold or copper, any mined commodity, interested investors can bet on the commodity itself. So for uranium, they could buy uranium participation or yellow cake, like a fund that holds physical uranium. Or of course, they can buy stocks if they want to trade the additional risk of exploration or producing for that leverage that should come with owning a stock. When we look at the uranium equity space today, what kinds of options are there for interested investors? And I ask this because this long, deep bear market left behind a pretty ravaged sector, and there aren't a lot of companies out there. So how would you explain or capture sort of the options that are out there for investors who are interested in betting on equities?
Yeah, certainly, Gwen. Well, this downturn's it's led to a sort of Darwinian situation, I suppose, where we've survival of the fittest. There's only a few of us left, a few true believers. But of course, generally stepping back from all of that, you've of course got the sort of hierarchy of companies and vehicles you can invest in. There are ETFs, of course, a few of those around now. Of course, Scott's involved in UPC and Yellow Cake's another one of these holding companies, which, are very low risk bets, I think, on the uranium price, but they lack a bit of leverage that you would get from the mining side of things. I think, Scott's set up with Amir Adnani URC, Uranium Royalty Corp. I think that's a very interesting advance or development in the sector, because of course you've seen the success of guys like Sandstorm, Wheaton Precious Metals, those streaming companies have done very well and probably done better than their sort of comparable mining companies in recent times. So I think that's a very exciting development and a thing to look at. And then of course you've got the usual suite of producers, developers and explorers, of which there are very few left. I think some of your viewers and listeners, Gwen, have seen me present on this before. I put up a couple of charts there, a pie chart and a bar chart. And the pie chart talks that we put up is twofold. The combined market capitalization of our sector today is about $12 billion. Go back to 2010 and it was 140 or 150 billion dollars. So the beta potential in the sector alone, when you get a market, is extraordinary. Every stock could be a 10 bagger potentially. And certainly during that last boom, Rick Rule talks very fondly of the stupid companies he invested in. The very worst he did was 22 times his return on his investment, not 22%, 22 times. And of course, Paladin was 1,000%. So, 10,000% or thereabouts. So, you know, the sector, when it takes off, really moves. And for investors, the job's largely done for you. There's no easier sector to invest in today because there's only about 50 companies that you would consider as investment grade or something that you would put money into, active companies or companies run by good management. And it's, you know, as part of that, you look around the group of companies out there, and there are very few shonky companies left. You know, most are run by, you know, guys like Scott and myself that are hardcore believers in the sector, that have done the right thing with investors' money to get through these lean times. So you know, straightforward to get invested. And you know, of course, what we encourage people to do is you can look at all of those things. But when it comes to looking to developers and explorers, NextGen, you know, stands head and shoulders above the rest in my book. And ISO Energy, you know, we're the only company in recent years with a high-grade discovery. So I think you should weight your portfolio to that side of the equation. That's what I've done.
Well, that sort of leads us into the next segment here. So obviously, I asked you two to be part of this webinar because you both have very deep knowledge of uranium, which we've just gone through, and thank you so much for that. Also, it's because you're both involved in two companies, and the four companies collectively sort of span this investment horizon. So there's ISO Energy on the pure exploration end. There's NextGen. Craig was a founder of NextGen. They're a very significant developer in the space. And then, of course, on Scott's part, he is executive management with Uranium Energy, who is ready to produce into the U.S. market from permitted in situ mines and has a process plant. And he is now leading the charge at Uranium Royalty. So we're going from exploration all the way through to the only uranium royalty opportunity out there. So it seems fitting here to give each of these guys a chance to tell us about those stories. I'm sure they'll each focus on one more than the other. But Scott, if I could get the background team here to make Scott the presenter, then he can take over here and share his screen and take everyone through a look at his investment options in the uranium space.
Great. So can you give me the control on the slides?
Okay. Is it there now?
Yeah, can you see it now?
Perfect. Yep, we can see it.
Excellent. Good. Well, let's jump right in, and this is going to be a lightning fast presentation because we want to get through the two companies here before the hour's up. But Craig really touched on it. The founders of Uranium Royalty Corp, we've been a private company up until our IPO of December of last year. Founders kind of looked out at the unbelievable success of the royalty and streaming model that we've seen in base and precious metals. Franco, Royal Gold, Wheaton, Sandstorm. They've emerged into a $40 billion industry, and they provided a very attractive vehicle for investors to get diversified exposure into a particular commodity. But they've also provided a very attractive alternative means of finance for mine developers and producers. So we wanted to be the first mover in that space. We did so in December of last year. We launched our IPO. It was, I think we were seeking to raise 20 million. We were offered about 40, and we took 30 in the IPO raise. Just to put it in perspective, in Canada last year, that was the largest mining IPO, which is hard to believe. It says something about where we've been in mining IPOs lately, but also our ability to raise in a difficult market. It was $1.50 a share and a listed warrant, a full 5-year warrant at $2, and the lead bankers are BMO, TD, and Haywood. So we were very fortunate to launch when we did, obviously not seeing the financial market turmoil that would ensue in 2020. But again, the highlights of this is really just to be the first mover. We don't think we'll be the only player in this space forever, but for now we represent that advantage to get into a industry that really needs alternative forms of finance. We have a huge billions of dollars of investment needed in the coming years. It's going to require debt, equity, and royalties and streams to build the mines and the next generation of mines that need to meet global uranium demand. So we want to be in there early and be a part of it. Today, as we sit, we have about 43 million in cash and listed securities. We've deployed that a little more cautiously, and I think going into the year, we very much anticipated to be well into deal number 1 or 2 in the portfolio, over and above what exists in the portfolio. But I think the coronavirus hit to the financial markets did cause us to be a little more cautious. Really, as a capital provider, we need to know what is the true cost of money and where is this all going to come out in terms of global markets. So been a little more cautious, but the war chest is full, and we're definitely very actively in discussions with a number of developers and producers to add to the portfolio. We have a very significant stake in Yellowcake, which is the London-listed pure uranium ETF, if you will, a 9% stake, being part of their IPO a year and a half ago. Basically gave us a stake in $21 uranium that was acquired at the time, and a number of other strategic alliances with Yellowcake. The maiden portfolio, I won't be able to go into it in too much detail, but it's definitely diversified right out of the chute, and obviously we'll continue to build on that. The team is very small, but I think very experienced. Just on the technical side, we're very fortunate to have, some longtime Cameco people like David Newberger, who was VP of mining for Cameco and developed and ran the biggest, highest grade mines in the world in Saskatchewan. Darcy Herscorn, a 20-year geologist with Cameco all over the world. So, due diligence and really understanding our counterparties from a mining engineering geological standpoint is critical. We have them. Lady Barbara Judge, who served on the boards and advisory boards of everything from TEPCO to Emirates Nuclear to the Astana Stock Exchange, certainly opens doors for us on the broader picture. Amir is the visionary founder and chairman of the company. And then I certainly bring 35 years of experience with 3 of the 5 largest uranium mining companies in the world. So we're very, for a small team, I think we've got the right folks. In terms of where we're at today, we have a market cap of around 81 million, 72 million shares outstanding. These are Canadian dollars. The shares, if you took a share and a warrant in the IPO at $1.50, those shares and warrants today are trading, roughly $1.48, $1.50 combined today. So it's really weathered through a very difficult start to 2020. But again, we're looking, this is a growth portfolio, and I guess we're proud of the existing portfolio that we have in place, and I'll go through it just briefly. But the growth is going to come from the projects in development, in production, that provide near-term cash flow, production cash flow to our investors. You see some of the key investors there: Marion Katusa, Rick Rule, Extract Capital, Darren Millmeister. We have corporate shareholders: Uranium Energy, Altius, Mega, which vended in assets for ownership. But again, very patient, long-term holders. I think in terms of time, I'll go very quickly. I mean, any good royalty company is going to be diversified in terms of geology, mining techniques, geography, stage of development. So, we're going to have longer-term plays that we invest in, and longer-term plays that we tuck away that'll provide value for the company down the road. We're going to invest in stuff that is cash flowing, producing cash flowing in the near term, and stuff in the medium stage as well. So, we really want to maintain that balance with an eye, though, to obviously near-term cash flows. With direct exposure to the current spot price, one of the reasons for the Yellowcake investment was to give early investors leverage to that $20 uranium that we acquired in the foundational shareholding. And then obviously royalties in the existing and new portfolio are leveraged to increasing uranium prices. So if you're getting in now, you're getting in at a very interesting stage. And I got to tell you that the pipeline for projects in this industry is quite extensive. As I said, there's a whole new generation of mines that need to be financed and developed in the coming years, and we intend to capture a good share of that. In terms of what we bring to counterparties, we're not just a bank that just doesn't have a vested interest in this industry. We are uranium people. We've been in uranium our whole lives. So we want to come alongside the more promising, the companies of all the universe of miners, developers out there. We want to partner with the ones that are most likely to succeed and execute on their business plans and be part of that success story in the coming years. We also bring advantage to, we expose that company to broader capital markets exposure through our activities. And we certainly can bring advice and our experience to their marketing. We have a counterparty that we met with recently where we shared an entire day with their board to just talk about marketing and sales strategies for the company going forward and helping them kind of craft their development and timing decisions for new production. So again, it's a real partnership with these companies that we join. In terms of time, I won't go into the portfolio. You can go into uraniumroyalty.com and see where we're at presently, but I mean, just touching on it very briefly, I mean, we've got everything from Langer Heinrich, which is probably a nearer term cash flowing asset. They've gone through an optimization plan at that mine to restart at a lower production cost. We've got ISR interests in the United States. We've got conventional interests in the US. And in Canada, certainly some very significant holdings there. The Yellowcake investment, it also gives us access to the Kazatomprom long-term sales agreement. We can buy up to $31 million worth of uranium under that agreement, and also allows us other strategic cooperation with Yellowcake. And so we're quite pleased with that investment. Just to give you an example, though, I mean, here's a royalty that we hold on Rough Rider. It's close to 2% gross revenue royalty on a project that was, obviously the subject of a $600 million bidding war between Cameco and Rio Tinto. This is not going to be something that comes on very quickly, but this would be categorized more as a tuck away that, as the current generation of mines in the Athabasca Basin phase out or deplete their resources, the next generation of mines, whether they be on the eastern or western side of the basin, come in to fill that gap. We believe this is one of those that'll be in the mix. You can compare that to, say, Langer Heinrich, which is obviously an established mine in standby and will can restart in a $45 uranium market to provide cash flow and revenue. So with that, I'm just going to turn it over to Craig and not steal any of his time, but URC really presents a great investment vehicle if you believe in the uranium story and the nuclear energy story. There are pros and cons to investing into the individual companies, but if you want to diversify across a portfolio of mine developments and producers, URC is an excellent vehicle to do that. And the timing, obviously, where we're at in the uranium cycle is opportunity. We feel very fortunate to be up and running, but still very early stages. We've only been a public company now for less than half a year, so we're eager to see what the months and years ahead of us bring. So with that, I will turn it over to Craig. If we could give Craig the control of the screen.
Good on you. Thanks, Scott. Is that working? Thanks, Gwen. Yeah, thanks, Scott. I think URC is a very, very exciting story and something of a innovative change to the investment landscape in uranium. A little bit about ISO Energy. I think quite a few of your listeners, and I think Gwen, you've got over 120 or 30 people on the call today. So good work there, and certainly another pointer to the interest picking up in the sector. So ISO Energy, of course, we're a spin out of NextGen Energy. NextGen, of course, I helped Lee start NextGen back in 2011, met with some success there at the Arrow discovery, and of course that left us with an interesting challenge with all of these other assets and ideas we had in the eastern Athabasca. So we spun that out, and I moved my family to Vancouver back in 2016 to run the company. And of course, you know, what we've been able to do there at a time when the market has been very, very challenged is raise capital, largely because of the success that we'd had at NextGen. And that enabled us to put our foot on some very, very good ground out in that prospective eastern Athabasca, which I think arguably is still the most prospective place for high-grade uranium deposits in the world. And then back in 2018, we sent a rig, we acquired our Roccas property off Cameco. We put a rig out there 6 weeks later, and
Oh, Craig, we've lost your sound. Oh no. Can you hear me, Craig? Uh-oh. I will do my best to try and get Craig's sound back. Oh, that's too bad. Let's see.
#1 drill hit in any commodity globally this year. So hopefully, sorry, Gwen, I'm having a couple of technical difficulties here.
Yeah, your sound is cutting in and out a bit, but you're back right now.
Okay, got you. Well, I'll try and get through this quickly to hopefully avoid the problem. So look, very, very high grade uranium mineralization there. You can see on the right-hand side of the screen there, we've had a slew of amazing drill intercepts, some of the best drill intercepts in any commodity this year so far. And we continue to advance that project forward. Just to take a bit of a step back though, you know, where we're focused, our strategy, what we're doing, we're focused on the Athabasca Basin, which is, you know, has the highest grade deposits and the 2 largest mines in the world, and of course is in Saskatchewan, which is typically rates #1 or 2 on the Fraser Institute survey of mining executives in terms of mining jurisdiction. We've got a fantastic team. The guys have had a real track record of success. We piggyback off the team there at NextGen, but we've got an exceptional exploration team led by Steve Blower. Steve was the head of exploration at Denison. Steve led the Denison team there to discover the Griffin deposit, and now he's done it again with the discovery of Hurricane. A little bit about timing there. Of course, you know, it's been a great period for the last 4 years to put your foot on very prospective ground in that eastern Athabasca when no one else was doing much. So we were in a unique position there. And in terms of leveraging our strengths, we're uniquely positioned in terms of, or being, you know, very favorably positioned to be able to raise a lot of money when others couldn't. And that's allowed us to put together this massive land position we now have out in the eastern Athabasca. When we inherited an original 5 properties, relatively modest sized properties there off NextGen back in 2016. And we've now built onto that massively, both through deals that we've done and through staking. And you can see here, Scott mentioned the Rough Rider deposit sits right next to our radio property, which is again right next to the McLean Lake Mill. And then the Rockies property, where we've made our Hurricane discoveries, only 40 kilometres away from that McLean Lake Mill. And important to note, that 120 kilometre long by 40 kilometre wide zone hosts some of the most important uranium infrastructure and mines and deposits in the world. So it is the home of the highest grade and biggest mines in the world, which is important. Just zooming in a little bit on our Rockies property and where we are, again, 40 kilometres from the McLean Lake Mill. There's a road that goes quite close to the property, of course, and we've made this Hurricane discovery up there. You can see our broader land package there as well. Zooming in on the deposit. So this is where we've been focused for the past 2 years. We've obviously, we put our initial hole back in 2018 here. We were following up these 2 drill holes, Kerr 12 and Kerr 11, that Cameco had drilled some years ago. We thought that they were near miss holes and quite close to you know, higher grade mineralization. They were highly altered. They had elevated radioactivity. The guys did some geological interpretation work, and I think this is a great bit of geological detective work, if you like, to delineate some targets to the north there based on our structural analysis. we put in that hole 1801A and hit 1.3% uranium over 8.5 meters. And since that time, we've gone on to drill these really significant hits, and you can see these higher grade cores to the deposit, and this high grade core on the western end of the deposit is where we've been hitting some serious uranium mineralization. A couple of important things about the deposit: we're relatively shallow, we're only 320 meters deep. We're 40 kilometers from Orano's McLean Lake Mill. McLean Lake Mill, of course, is currently underfed, albeit because of COVID-19 it's closed at the moment, but it has 24 million pounds per annum capacity. It's only seeing 18 million pounds go through it at the moment. And when Cigar Lake dies down come 2026, 27, that mill runs out of feed. So we're uniquely positioned in relation to that. And very importantly, we're not under any lake cover or water cover. And the last thing I'd point out is that we've actually engaged Peter Longo, who was the COO at Denison, or head of VP of Studies and Projects at Denison, to look at how you would mine an ore body in this area. And I suppose what we know is that Orano has their Sabre, which is borehole extraction technology for this kind of mineralization, and there are a number of other possible mining scenarios. And I think, you know, Peter conceptualized and did the initial work on Denison's in situ leaching of unconformity related mineralization, and that's what some of the things that we'll be looking to do. Just pointing out a bit more about the geology. This is one of the cross sections there in that very, very high grade hole 34, where we hit 8.5 meters at 34% U3O8. You can see the unconformity there. This tanned area or yellow area is the sandstone. Here are the basement rocks, and you can see that flat lying unconformity associated mineralization sits right at that structure. Very importantly, these big basement tapping faults and structures cut through the unconformity, and you can see here that there's a rise or an elevated area in the basement. That's something we call a flower structure. Interestingly, that sort of structural setup is associated with some of the biggest and highest grade deposits in the basin, like Cigar Lake. And very importantly here, you'll note that we haven't closed off that section. In fact, we haven't closed off any sections bar one. So our plan for summer is to get back in and drill in and around those holes to close off those sections as we move to announcing a resource. Another example there, Gwen, of a section there, very high grade section, which again we haven't closed off. You can see there this whole 14.5% U3O8 over 7.5 meters and not closed off yet. So we'll be stepping out in summer to test those as well. And stepping out a little bit further and looking at the broader Roccas Property, Hurricane sits down here. You can see this very prominent resistivity anomaly. There are a number of mineralized intercepts in historic holes all the way along that anomaly. There's over 12 kilometers of outcropping, of known conductive rocks and structures there. So plenty of work to do to follow those up as we go. But right now the focus for us over the summer months will be drilling out the deposit before we go and test some of these other targets. So plenty of exploration upside there as well. The deposit, classic unconformity related Athabasca deposit, but you'll see here not terribly deep, only 325 meters, and considerably higher up in that column than say a Griffin and MacArthur River or Cigar Lake. Just very quickly on the share price and where we're at today. We've had a good run since with the sort of the very down market that we suffered due to COVID-19 back in March, trading around 70 cents today, which is gives us a market capitalisation just north of $50 million. We're very well supported there, as you can see, by NextGen. NextGen owns 52% of the stock. NextGen's contributed significantly to each of the last capital raises we've done, and I think it's safe to say that Lee Courier, the CEO of NextGen and our chairman of ISO Energy, would love to own more of this, not less. And importantly, we've got Orano and Cameco with material positions there as well. Also worth pointing out that our institutional shareholder base is very, very strong. We've got guys like Segra, Satcham Cove, Brian Lax at Old West, some of the thought leaders in the space, guys that have been moved to invest in the space early on. And we see them as sticking with us for the longer term as we drill out our Hurricane deposit and test some of those other targets. So we really think our free float is probably only 20 to 25% of the stock. So we offer investors a lot of talk whenever we put out good results or the uranium price rises. We've got $3.5 million in the bank today. We don't need to come back to the market. I mentioned up front there, we've had quite a few offers of financing in recent times. We're not looking too seriously at any of those just at the moment because we're funded for our summer drill program. A little bit more about the team. I mentioned importantly Steve Blower there, and Steve's been a tremendous addition to the team. Some of these faces will be familiar to most of your viewers because they make up a large part of that NextGen board. I was on the board there at NextGen until recently, but I remain a senior advisor there. Those guys have got a tremendous track record of adding shareholder value to uranium companies, so we're well supported there. So when that's really it at this stage, where I think what we're trying to be seen as is really the go-to name in exploration as this market kicks off. I think in the last 2 or 3 years, we're the only company with a serious high-grade discovery. We're drilling that out as we speak. We'll have a drill rig on the ground. We've actually got 2 rigs out there at the moment, but we'll be back drilling come late June to mid-July. And I think people can expect from us some, very, very strong news flow as we get in and test in and around those very high-grade hits as we move towards our goal of announcing a maiden resource sometime early next year.
Fantastic. Thank you, Craig. All right, I'm going to move into some questions that have come in from the audience. Certainly, if you have questions, please keep them coming. Click the icon, type them in. They pop up for me so I can forward them on to these guys here. So I'll just start, Craig, with a question that came in during your presentation for you, which is who holds the land package just to the west?
Yeah, good question. Very good question. And that land package to the west is, and of course, certainly we make no bones about the fact that our Hurricane deposit almost certainly continues to some extent on into that ground. We'd love to own it, of course, but that package is part of the Dawn Lake joint venture, which is majority owned by Cameco, and Orano are the minority shareholder there. We make no bones about the fact that we'd love to have a position in that ground, but if we can't get a position in that property, then we'd love to see Cameco and Orano out there and testing that deposit. And I think what we've heard from those guys is that they see Hurricane as being a significant discovery and would like to get in and follow that up.
Fair enough. Yes, important thing that investor noticed that the deposit runs into a property boundary there. Scott, let's move over to you. We did not, in our conversation of the uranium macro picture, talk at all about U.S. politics and things like that. So the question specifically is, how does the recent uranium reserve program affect things? Will it affect prices? Maybe just talk around that whole nuclear fuel working group a little bit and add that to the picture.
Yeah, well, this time last year, we were all watching the Trump administration to see whether he would go down the same path as he did on steel and aluminum, using the 232 tariff and quotas to correct oversupply of foreign, in that case, steel and aluminum, impacting national security. Similar filing on uranium, as everyone knows. Perhaps out of character, Trump decided against tariffs and quotas, but perhaps embarked on something that's probably more meaningful and more lasting at the end of the day, which was this nuclear fuel working group, which was a task force comprised of cabinet level departments and agencies to come up with policies that can be enacted to revitalize the American nuclear fuel cycle, uranium conversion and enrichment. The U.S. is now relying was the largest nuclear market in the world, is relying 99% on foreign imports. Canada's fine, that's not the problem, but even Canada is impacted by these state-owned companies like Russia and Kazakhstan that have really driven prices below where they should be in a free market. So, the reliance on Russia, Kazakhstan, Uzbekistan for 42% of that 99% coming into the U.S. really was deemed to be a concern for the administration. And so the report finally came out last month, which was probably the most pro-nuclear energy advocacy policy we've seen out of the White House since the Eisenhower administration in the 50s. But what it means for uranium, and I think, in terms of global producers of uranium, I think it's much less disruptive. It's not based on trade restrictions, but more incentives to stimulate the domestic uranium industry, a national uranium reserve, similar to what we have with the Strategic Petroleum Reserve, $150 million a year, $1.5 billion over 10 years. A stop to U.S. government inventory sales into the commercial markets. And three, really advocating for continued restrictions on Russian supplies into the United States at the current 20% level, which currently exists, or less. And that's playing out in the Commerce Department right now and in Congress. So to have the president chime in and support that was very positive. So again, I think there is uranium industry in the United States that has very competitive mines that can be in the lower half, I would say, of global production cost, which makes them competitive, especially if they're permitted and licensed. I think the Nuclear Fuel Working Group, obviously it needs to be funded by Congress, and a lot of efforts being made to that right now, but we see it as a positive step. But I'm perhaps as optimistic as we are and thankful for the support from the Trump administration in the US. I'm more optimistic about just the general market fundamentals of supply and demand that are getting uranium prices back to not just incentivize mines in the US, but the better mines around the world that can compete with a little bit more of an incentive price present for them.
Yeah, for sure. Yeah, okay. That's certainly that was a big there was a huge amount of anticipation that built up around that, and then it sort of eased off because it wasn't the dramatic outcome that we all wanted, but it now just ends up being another piece added to the pile of forces that's working for uranium. One or the other of you for this, nobody in talking about the supply demand balance in the sector talked about secondary supplies. Does one of you want to start talking about secondary supplies, what role they play, how they've been changing?
Yeah, again, that's, obviously it's easy to tell how much uranium we're consuming each year. The reactors run 24/7. The mine production is quite transparent. It's the secondary supplies that are hardest to get our arms around. But, we have been in a drawdown, an aggressive drawdown now since, really since 2017 and accelerating now with COVID-19. And, if I had to peg, what's excess to the market could be as much as 50 or 60 million pounds, which sounds like a lot, but that's we consume 190 to 200 million pounds in the world today. But these are pounds that I would say are excess. I mean, you can't count excess. You can't count Chinese inventories, for example, as excess supplies. They've acquired that in a strategic fashion that will go to their requirements. The Japanese utilities, amazingly, I mean, there's been a little bit of leakage of those inventories, but by and large, they've remained intact and they'll be used for their future requirements. So I'm only concerned about what can be liquid and available to the spot market when we have this discussion. And that's very, out of the global universe of inventories, it's really quite a small amount. And that would be borne out by buyers in the market that are going in to buy, like Cameco, that's now buying, significant 1 million, 2 million, 3 million pounds at a shot, and finding very limited supplies on the supply side. So again, I think we're, to use that bathtub analogy, now that we've turned the faucet down, the water level's going down in the bathtub. The water's not swirling out the bottom yet, but it's getting there very quickly, especially with COVID impacting 50% of global production. And even with COVID passing and mines coming back into production, Craig mentioned that, you know, the Kazakh production can't just flip a switch and come back on. There's a big lag for them to repressurize those well fields. You know, there's no well field development occurring in Kazakhstan right now. That's a big delay to get them back into production. Cameco shut down Cigar Lake because of coronavirus health and safety concerns, but the restart considerations are purely commercial, and they'll be the same decisions they use to restart MacArthur. So, you know, what is, you know, some had anticipated could be, you know, a 2-3 month impact due to coronavirus. You know, the impacts could be much longer and really push that global production number down below 120 million this year is very, very much likely.
Gotcha. Okay. Somebody posed the question, people who believe in the uranium sector have already invested, you know, whether in recent months or recent years. And the question is sort of what will bring new money into the sector to drive prices up. And I wanted to add to that a comment that somebody sent into the question line, which is Peter Grandich, a generalist investor, appeared on the Money Talks radio show last weekend. Last year, he recommended gold. Now he's recommending uranium. So interest in the sector is starting to pick up. Craig, do you want to maybe, I mean, Scott did a great job of talking about the sort of compression and drawn out supply response in the space and how that impacts prices. Maybe talk about the size of the space and investor interest and, you know, it's a small sector when investors do start showing up.
Look, it is a tiny sector. You know, the sort of big funds of the world don't see much in the mining industry as being of investment grade. You know, Warren Buffett won't invest in mining companies. None of them, in his view, are of size or grade to be investment quality. You look at the uranium sector. Well, okay, so here we are. We've got a sector that's got a $12 billion combined market capitalisation. We provide the fuel for 15% of the world's electricity needs. You then compare that to something like Saudi Aramco. Now, I haven't looked at their share price recently, but they're certainly going back 3 or 4 months ago. Saudi Aramco had a market capitalisation of $1.2 trillion. So 2 orders of magnitude bigger than our combined sector. That company provides 13% of the world's oil and gas needs. So there's a complete disconnect there. Something's wrong. Something's going on. You've got a sector that provides the only known form of clean, non-renewable, clean green baseload zero carbon energy from the mining side of things. So there's a complete disconnect there. But I'm sort of getting a little bit off topic because it's something I'm passionate about. Because if people want zero carbon energy, they're going to have to pay more for this product. But going back to the size of the sector, $12 billion market cap, Saudi Aramco 1.2 trillion. There's not many places your money can go. Cameco, of course, you know, $4 billion company today, was a $30 billion company not too long ago. Kazatomprom there, you know, relatively newer to the space, but again, only a $3 billion market cap. They're the big companies of the space. It's fascinating. So I think it was Doug Casey that liked to say that when investment dollars, when generalist funds come into the gold space, it's like trying to squeeze the volume of the Hoover Dam through a tube. When it comes in, or a hose pipe, when it comes into the uranium space, is like trying to squeeze it through a straw. So there's not many places that money can go. So we're perfectly set up.
Oh, his sound cut out just as his answer ended, so that worked out fine. We only missed the last few words there, Craig, so that was actually okay. Scott, I have a fairly specific question for you. An investor is wondering whether it is better to invest in the warrants or the shares of URC.
That's a good question. You know, a 5-year listed warrant at a $2 strike price is, you know, a lot will happen in the next 4 to 5 years. So you know, those are quite an attractive way to play it. But you know, listen, you know, I feel this way, and I know the founders of Uranium Royalty feel this way. there's no reason why Uranium Royalty can't be a billion-dollar company in the coming years. It's really just a matter of how quickly we execute on those plans. If you look at the pipeline and the need for new production, and the attractive features, non-dilutive features of royalty and stream financing, we're at a very early stage here at the right point in the commodity cycle. So I would say, if you got in on the IPO, you're holding both. But yeah, I think both of them bring, a lot of attractive features. And again, I think touching on, the other alternatives, if you believe on the nuclear narrative and uranium story, there are very few, doors that investment capital can flow through. But a diversified mix of explorers, of developers, of producers. If you want the low risk option of the UPC, Yellowcake, or diversified of URC, these all have a fit in a portfolio. I would never suggest that you invest in one company in the space, but rather pick some of your favorites and spread that risk around. I think coming next 5 years, that'll really pay off dramatically.
All right, let's wrap it up. We've been going for an hour and 15 minutes. I don't want to take up too much of anybody's time, but let's finish with, the easy, not easy question, which is, there's been a couple questions, quite a few people asking where, for uranium price forecasts. And I know I'm sure you both love being put on the spot for that. But maybe, I don't know, at the end of the year, let's just choose a time frame. So at the end of 2020, do you want to take a stab at where you see the uranium price?
Well, it's dangerous. I've been predicting the uranium price for the last 35 years. One of these days I'm going to be right. But again, I just, I think you just need to look at the fundamentals. And I don't care any commodity that has a situation like we do, where the demand is as strong as it is, robust nuclear growth, production cuts to such a severe degree that have occurred for years, now only made even more steep in terms of coronavirus. And it's really the last shoe to drop is that utility procurement, which has been delayed by trade actions in the United States and now delayed by COVID. Those utilities have to come up for air. Those plants are running 24/7, and the old contracts are running out, and these sort of carry trade and trader short-term strategies aren't as attractive as they were even a couple of years ago. So, listen, we're at $34 today. Is it reasonable to think we'll be at 40 by the end of the year? Absolutely. But it all depends how quickly those utilities come out, and the price discovery will happen, when they come to the market and they see that the supplies aren't as abundant and diverse as they were last time they contracted in the previous cycle.
And I think the crazy thing too is that previous uranium cycles have shown on repeat that when the price moves, it sort of waits and waits and waits and then goes. So even if the price is only, I'm being sort of facetious here, but still $40 at the end of the year, it could move dramatically beyond that in some very short time frame right thereafter, or just before. You know what I mean? That's why it's very difficult to ask this question, because these moves happen so rapidly when they do. Craig, do you want to take a stab?
Yeah, well, I thought I'd let Scott go first so I could be better informed with my answer. But look, I think, as we talked about there before, the fact that because Atomprom won't be supplying the spot market this year, the utilities have been incredibly complacent. They've had all the product they want as cheaply as they want it for the last few years, and they haven't looked, I don't think they understand just how tight and challenged supply is. So look, by the end of the year, and I've got to preface this by saying I've been consistently wrong for the past 8 years, so take it with a grain of salt, but I really think that we'll see probably $50 a pound by the end of the year when you see that product. It's jumped 45% on the threat of product disappearing in the market. When we actually see that product dry up, things will move. I think the more interesting question for me would be, what about the end of next year? And of course, we know when things tighten up, always in commodities, things overshoot on the upside and the downside, and we've seen that massively in this downturn. I think we'll see it massively again, and we know that the major producers really, apart from Kazatomprom, need to see north of $50 a pound before they get a return, and then the incentive price for new product to come on stream is probably of the order of $75 a pound. So I think over the next year or two we see the price shoot well past $75 a pound. Will we see $143 a pound again? Don't know, but I really think that in the next few years we'll see $100 a pound.
I think that's a great note to end on. Thank you, everyone. Thank you, everyone, for listening. And thank you certainly to Scott and Craig for all of your time and for your insight today. There was a lot of information in a short period of time. I know there were more questions that came in. I had to sort of pick and choose just based on covering topics and not taking up too much time. So these gentlemen are easy to find on their various websites if you have further questions, or you can send them in through the Resource Maven, this webinar platform, and we can get them to their destination, and you can get those questions answered if you want to keep sending them in. So thanks, Scott. Thanks, Craig. Thanks, everyone, for listening. And everyone, have an enjoyable rest of your Tuesday. Forgot what day it was.
Thanks,
there for a minute.
Thank
All
you,
right.
everyone.
Bye-bye.
Thank you.
Bye.